Pollin. And all right, well, we have a good number of participants here. The way this is supposed to work, actually, this is Phil Steck, Assemblyman from Albany and Schenectady counties. The way this is supposed to work, which we did not accomplish, is that the hosts have audio capability, but the participants don't unless I recognize them. So I would just ask people to observe that convention in the absence of this operating the way we had planned it. So this is, the Assembly loves to call these things roundtable discussions. To me, when I hear the word roundtable, I think of Monty Python and the Holy Grail. The idea of this panel discussion is not to be like Monty Python. There's a lot of ham-handed comments that are made about the stock transfer tax. I wanted to convene this panel to have a serious discussion of this issue. This tax existed in New York from 1905 to 1981. And it was originally introduced by the Republican Party because the Republicans preferred sales tax to income and property tax. And as a sales tax, it works the same way that you do when you go to the store. You pay the tax as a consumer, the merchant doesn't. So unless the tax is set too high, the customer is going to continue to buy the product and the merchant is not going to be hurt in any way. So we had this with great success in New York from 1905 to 1981. In the late 70s, it was transferred to New York City to help New York City out of its financial crisis. And then when the financial crisis was over, unfortunately, the mayor of New York at the time, Abraham Beame, was convinced that the tax was not needed anymore, and he prevailed upon the state to eliminate it. So when I came to the Assembly in 2012, by the time I had a little bit of introduction in 2014, we introduced a bill to reinstate the tax. But then we began to understand this issue a little bit better, and the current bill distributes the money all to infrastructure. However, for the first 2 years, because of COVID-19, we did change it so the money would go to the general fund so that we'd be able to save our state from draconian budget cuts that might be occasioned due to the COVID-19 crisis. So the way this is planned is that each of the panelists is going to have 5 minutes to talk about the subject. And we're still waiting for one of our panelists to get in. So I would start with Professor Robert Pollin. Professor Pollin was at one time requested to do a study of this issue by 2 members of the Assembly. That was in 2003. He's continued to study this issue. He's at UMass, and most recently I had read a 2015 article from the Brookings Institution, which cites him as one of the experts in this area. So, Professor Pollin, your thoughts to begin.
I'm happy to start. I think that Professor Stiglitz has just come on, so if you want to start with him.
Yes, I'm trying to find him because I don't think he entered as a co-host.
Okay.
But I assume they're looking at that.
There he is. I see him.
Okay.
Okay.
Yes, I see him. Yes, thank you. Do you,
Okay.
Professor Stiglitz, you have audio and can hear everyone?
I can hear you.
All right. Okay. So we were going to start with you. If you want to start, we can start with you and you can speak about it for 5 minutes.
Oh, sure. Okay.
But I didn't give the introduction. So as we know from the flyer, Professor Stiglitz is a Nobel Prize winning economist, currently at Columbia University, was chief economist of the World Bank, and most importantly, Phil Steck has read 2 of his books, Free Fall, which is about the financial crisis, and also his book on the negative effects of inequality in economics. So, Professor Stiglitz.
Well, let me just say a few words in introduction. I've been a big advocate of some version of a financial transactions tax, like a stock transfer. And let me try to explain why. In general, you should tax bad things rather than good things. That's why we believe a good thing to tax pollution, carbon taxes, because you get the benefit of raising revenue and discouraging activities that may be harmful. Now, one of the things that is my own research clarified was that there is excessive trading in financial markets. A lot of it is speculative. It leads to excessive volatility in markets. And so to the extent that a financial transaction tax or a stock transfer tax discourages this wasteful kind of economic activity that contributes to economic volatility, it is actually raising revenues and increasing the overall efficiency of the economy. Now, this happens to have one more dimension, which is that on average, the people who pay the tax tend to be in the upper income distribution. So in a country that has as much inequality as the United States, the arguments for a stock transfer tax are even more compelling. This is a particularly germane moment to be talking about this, because we will be needing enormous amount of revenues. The COVID-19 is resulting in marked decreases in tax revenues in all the states, and New York included. So we will have no choice but to raise taxes or cut back expenditures. And cutting back expenditures will have, if all the states do it, significant macroeconomic consequences. It will result in slowing down of the economic recovery, but it will also have very adverse social consequences because our healthcare system, our education system, our welfare system depends to a very large extent on state tax revenues. So there is a particular imperative at this moment to look for the best kinds of taxes that we can to raise the revenues that we clearly need. One more aspect of this is that I do not believe that there will actually be much of an effect of the tax at all on economic behavior, say a slight effect in discouraging excess speculation, but at the rates that people are talking about the tax, it is not likely to have any adverse effect, and as I said, may have some positive economic effects.
Well, thank you very much, Professor. I would note that one of the earliest proponents of this was John Maynard Keynes, the famous British economist, and many times in the assembly, I say that some of my colleagues act as if John Maynard Keynes had never walked the face of the earth, but fortunately he did, and a lot of our great economic policies came from that. So I had introduced Professor Pollin briefly. I also want to say that I did read his study from 2003 on the New York state stock transfer tax, and we will get into the issue of stock transfer versus financial transactions later, but Professor Pollin.
Thanks very much. I'm very happy to be here. I've read Professor Stiglitz's paper, I think from 1989 on this subject. It was one of my inspirations. So I was asked to address the issue of the employment impacts of imposing this tax, which was one of the main issues that I was asked to address way back in 2003. So I want to tell you a little bit about the results that I published in 2003 and then bring it up to date. Well, just as a matter of a statistical relationship, so we studied statistically the relationship between the level of trading volume that takes place in the New York Stock Exchange and employment in the financial markets. We did this study for this 25-year period up to around 2000. Statistically, we found no relationship whatsoever. And if people want to go back and look at our paper, we have a nice graph that shows that actually the stock market trading is going up and employment is actually going down anyway because the greater efficiencies that are taking place in the market. Now, that's a statistical relationship, but so why would we see this, that basically we find no relationship whatsoever? And let me just give some of the substantive bases for that. First of all, what we're really talking about with this tax as it affects people in the market, traders, it's the total amount of transactions costs. So the tax adds to the total amount of money you have to spend in order to effectuate a trade. Okay, so the real heart of the matter is how much are you affecting how much somebody has to pay to trade on the stock market. Now, as it happens, the New York Stock Exchange, for which this tax would apply, already has lower transaction costs than over-the-counter and NASDAQ. It did in 2003, and I've done an updated study published in 2018. There's various ways that you can measure transactions costs. Different researchers have different techniques, but the basic finding consistently is that the New York Stock Exchange transactions costs are lower. The reason they're lower is precisely there's more volume, there's more liquidity, and so it's easier to undertake trades. So we're already at lower transactions costs. So tacking on, and in this case, what we're talking about is a tax of 0.25% at maximum, which means on a $1,000 trade, it's going to cost $2.50 in the tax to do the trade. So it's not enough money to really make any difference in terms of the trading decisions of market participants. Now, another issue that came up back in 2003 and is still present is, well, why wouldn't the New York Stock Exchange just leave New York? Why not just go across the river to New Jersey? Well, again, the big answer is, yes, that could happen if you were imposing very significant costs on traders in New York. And they say, well, you know, we can't handle that. But again, $2.50 on a $1,000 trade is not enough to dramatically change behavior. On top of that, I mean, we already know, why wouldn't, if New York was, the traders were really concerned about this kind of small tax, they would have already moved to New Jersey because rents are much higher in New York than across the river. Rents are about 30% higher. So if all they were looking for is the lowest possible cost in order to undertake trades, they would have been in New Jersey a long time ago, or maybe they should move to Salt Lake City or someplace else. Okay, another consideration on employment is we have to remember that it's not like the money is just flushed down the toilet. The whole point of this tax, as Professor Stiglitz emphasized, is to prevent austerity budgets in the public sector. So the money is going to be taken from the stock trading activity, but then it's going to be rechanneled into keeping the public sector viable. So what really, as a rough approximation, what really is going on, we're taking money, small amounts on trades, and enabling public education and healthcare to continue to employ people. So actually the net impact on employment of this tax is to increase employment, not decrease employment. It may have some small effect, as Professor Stiglitz said, some small effect on employment in trading, but it is going to have a very large effect on increasing employment in health and education. So one of the things I showed in the 2018 paper, because of the fact that, as we all know, teachers, educators get paid a lot less on average than people on Wall Street. So if we transfer a given amount of money from Wall Street into education, you increase employment from $2,000 per $1 billion of spending to 15,000 jobs per $1 billion of spending. So we actually increase employment 7-fold just through that kind of direct transfer. Okay, what has changed finally since 2003? We still have lower transaction costs and in New York relative to the rest of the market. So we have lower transaction costs than in other market venues such as Chicago and San Francisco. So that hasn't changed. The final issue that I was asked to discuss that I'll just mention briefly is what about taxing other trading, such as bonds and derivatives? I support that. In this 2018 paper, I think if we're going to tax stocks, we should tax the market across the board and therefore prevent any kind of market distortion whereby traders say, well, hey, you know, we're going to have to pay a tax if we trade in stocks, so why not move into the bond market? Finally, I would just say other countries have these projects. You know, in London, they have a 0.5 tax. They've had it since the mid-'80s. It has not crashed London. London still exists, and it is the second biggest global financial market.
So I would note that Professor Pollin's work was cited in a recent study from the Brookings Institute, which also appeared to join in the view that other financial instruments should be subjected to the tax. Now I'd like to introduce James Henry. James is a former chief economist at McKinsey and Company, which we know is one of the leading business consulting firms in the world. He's a global justice fellow at Yale University and senior advisor to the Tax Justice Network. James? Uh-oh.
Good to be with you. It's an august panel, and I'm proud to be on it. I'm coming at this from the standpoint of my work with the Tax Justice Network, which is an organization that spans now about 55 countries and has been active in the last 2 decades with the mission in mind of trying to close down tax havens and strengthen international income taxation, corporate and individual. But we've also been active in supporting the EU's efforts over the last decade to revive the financial transactions tax. I think we're seeing some progress there. Angela Merkel, as president of the EU, beginning last month, has vowed to revive it. And she's got 11 countries already signed up for it, which are about 95% of EU GDP. Unfortunately, the UK has decided to take itself out of the EU, and so we'll have to deal with how they tax transactions from that important banking center. But generally speaking, you know, one of the key themes here is that economists, the most brilliant economists in the profession, including Professor Stiglitz, I would include in that category, you know, Keynes in 1936 said that we have to, the thing about casinos is you want to make them hard, inaccessible, and expensive, and that was his reason for supporting this tax. James Tobin, a Yale professor and Nobel laureate, famously proposed a variation on this tax called the Tobin tax, which was supposed to be a global tax on currency transactions. He said, you know, basically my idea fell like a stone into the bottom of a well. And so one of the mysteries here is, given the kind of extraordinary group of economists who've supported this, what's missing in the political sort of base that we've found, the coalition building that's necessary to get this kind of tax adopted? Well, I think what's been missing is precisely the kind of crisis that we have now. I mean, New York City is facing a $9 billion budget deficit over the next year. New York State is facing a $60 billion four-year deficit, at least, going forward. The governor hasn't indicated yet what his plan is for that, but he has been counting, I think, to his regret, on the federal government bailing New York out. He's not a tax guy. He's interested in, probably in this election and his political aspirations, you can speculate about, but he's always been kind to Wall Street when it comes to regulation and taxation, by and large. And I suspect that left to his own devices, he won't want to have anything to do with this. It's up to us to organize and to lobby and to pressure and to explain why this is a good idea. Otherwise, I think he'll take the path of least resistance that keeps his Wall Street friends happy. That's an extraordinarily concentrated crowd, it turns out. Because if you actually look at the numbers, most recently this year, there's basically a handful of exchanges in the world that account for most of the stock trading. And 80% of the trades that are going on are fast trades, high frequency trades, the kinds that are reversed within minutes and are arguably very much subject to the criticisms that Keynes and Tobin and Stiglitz and Summers and a long line of other distinguished economists have made. It's basically kind of market as a casino, which not a very productive activity for us to be engaged in. If you look at this year's transactions in the top 5 securities on the NASDAQ exchange, which is based in New York, that would be Apple, Facebook, Google, Microsoft, and Amazon. The total volume of transactions in Apple alone, the market value of all trades is roughly equal to the market value of the stock. The market cap of Apple is now 2.2 trillion. Well, their trades added up to 2.2 trillion. For the top 5 companies, the figures added up to roughly 8.8 trillion on an annualized basis. So if we simply applied a 0.25% tax to all that, that's about $21 billion of revenue just from the trading activity of those 5 stocks. Talking to my broker today, I said, would your customers be upset about a 0.25% of increase would you even miss it? And the answer is no. Now that's 3% of the NASDAQ's volume is accounted for by those securities. And so I think the thing that's really striking to me is, beyond the arguments about high frequency trading, speculation, and the progressivity of the tax, all of which have a lot of economic merit, there's also the basic fact that it's a low-cost tax to levy, and it's easy to raise a heck of a lot of revenue before they notice what's happened. That's why the EU is in favor of reintroducing this. They have a $750 billion spending plan, and they need to get every penny they can in tax revenue. So this is the ideal time for us to be advocating aggressively for this kind of tax, because the standard tax competition argument that they're going to move to New Jersey, or they're going to go to Chicago, or they're going to go to London, they're going to go to Frankfurt, doesn't really apply when you have every major country in the world facing massive budget deficits as far as the eye can see. And the poorest people on the planet, in many cases in developing countries, in an equally dire situation. This is exactly the time when we should be mounting an aggressive effort to argue for this tax. I think the last thing I have to say is that organization, basically, and not technical issues are the main obstacles that we're facing. That explains why we haven't, despite years and decades of economic analysis, been able to secure this. We have a very powerful, influential industry, not only in New York City, but also in Washington, and every major financial capital of the world. TJN, Tax Justice Network, has been battling that industry over havens. Recently, the OECD validated the estimates we had for about $50 trillion of offshore wealth beyond the reach of tax havens. With their latest estimates, those estimates of offshore cross-border deposits only came as a result of demanding automatic information exchange, country-by-country reporting, and more data on beneficial ownership. Over the last 15 years, when we started, we thought it was an impossible demand, but by arguing for it, setting high targets, and then aggressively organizing around it, we have most NGOs in the world are advocating for tax justice. So I think that's an example for us to learn from.
Well, I think from being involved in the day-to-day politics, I think that this is one of the main reasons we have this panel discussion, because a lot of people are just afraid of this thing. But the point I want to make again is that it was successful from 1905 to 1981 in New York State. And the London tax actually goes back in history to the late 17th century in its origin.
Yeah, that's
So
right. It's one of the most, it's probably one of the oldest continuous taxes in the world, is this 0.5%. Now, it's easy to evade, and it only raises about $3 billion a year. But the fact is there are 40 countries right now that have financial transactions taxes of various kinds. They come and they go. They benefit from having other countries adopting them. So one of the things that's interesting here is we now have, the more countries, the better. This is precisely the time that we'd like to adopt this. But basically we have, all of the BRICS countries, China, Hong Kong, supposedly the most competitive, except for the political problems now with China, one of the most liberalized countries in the world, or jurisdictions. South Korea, we have the EU now reviving a version of the financial transactions tax, India. So the United States would really be an outsider now if it did not follow along and join this, this growing demand for taxation.
Great. So I want to now go to Professor Zephyr Teachout, a professor of law at Fordham University, who's going to talk about some legal aspects to this tax.
Thank you so much. Thank you for holding this really important roundtable. My main job here is to preemptively respond to some concerns that I and others here repeatedly raised about this tax, in particular questions about its unconstitutionality, and those questions can inhibit the kind of robust political organizing that we were just talking about. So the bottom line is very clear at this point after a 2018 Supreme Court decision. This tax is constitutional for New York State to pass. So just so you understand what the argument about unconstitutionality is and why it is illegitimate, I'll be very brief. The argument relates to the grant of authority to the US Congress to regulate interstate commerce. Now, along with that grant of authority, courts have over the years recognized that while it gives Congress authority, it also in some cases limits what the states can do when it comes to interstate commerce. And the basic limitations are that states can't discriminate against interstate commerce or unduly burden interstate commerce. And so the way that you would typically look at that is to say, okay, in general, state taxes are legitimate. Of course, a state needs to raise revenues, and this is fine. The outer bounds are when the sort of key requirements, so there has to be a substantial nexus of the activity with the state. The taxes have to be fairly apportioned and not to discriminate against interstate commerce. It seems fairly straightforward and understandably how pretty common sense how this would apply to the stock transfer tax. For several years, the Supreme Court had a precedent, which was overturned in 2018, that the dormant commerce clause was violated if a state taxed activity when there wasn't a physical presence of the seller in the state. And this basically was came at a very unfortunate time during the rise of e-commerce and limited states' abilities to tax transactions that happened within their states, but happened with a seller who was operating online. In 2018, however, the bottom line is a majority of the Supreme Court overturned that precedent and said that physical presence of the seller was not required. In fact, they called it a judicially created tax shelter, the pre-existing rule. And instead said that what you need to look at is not the artificial test of physical presence, but the traditional nexus test. And the law, as I understand it's drafted, requires that the transaction be facilitated in New York State, and includes a clause saying that this is within the bounds to the limit of the bounds of what the Constitution requires. So just briefly before we move on to the substantive discussion, what this means is that after 2018, after this case, states rightly then felt far more free to do their basic job of collecting revenue for transactions that occurred in their state. I think sometimes people still think of the cloud in some ways as unreachable, but perhaps the best example of something that is concrete that relates to this is Chicago has an amusement tax that extends to Netflix streaming. After this Wayfair decision, everybody understands that that tax is not a problem. The transaction happens all online, but that tax is collectible. I am not alone in this. There's a general consensus of experts that the stock transfer tax falls squarely within the Wayfair decision. And in fact, many people looked to New York's a growing interest in the stock transfer tax as one of the areas where you'd see movement after Wayfair.
So thank you very much, Zephyr. I'd like to go back to Professor Stiglitz and ask him a few questions. And I believe he's now live again. So one of the excuses New York legislators give for not supporting reinstatement of the stock transfer tax is the assertion that it should be done at the federal level, which I believe is much less likely politically. Robert Rubin, former Secretary of the Treasury, wrote in the New York Times that he supports the stock transfer tax. However, he did not say whether he thought it should be at the state or federal level or both. The feds, in fact, once did have a financial transactions tax. What is your view as to whether we can do it at the state level?
Oh, I think you can do it. Professor Pollin has already answered that question. When we're talking about the kinds of rates that we are talking about, 0.25%, probably could be even higher than that, there is no evidence that people would shift the location of their economic activity in response to the tax. Now, I actually take a view that it should be a more comprehensive view. It should be a tax not only on the transactions that occur within the state, but the transactions of the residents of the state, no matter where they occur. So if we did that, we would be able to capture transactions that occurred in stock in other markets by any entity that is located in New York.
I think that the Brookings Institution article that I mentioned earlier had a lot of discussion of the Harkin-DeFazio proposal at the federal level, which seemed to have done a very good job, by the way, of expanding the tax beyond stocks to other financial instruments. And I know that Professor Pollin's work is cited in that article. I wanted to ask Professor Stiglitz another question. Do you believe that the stock transfer tax will adversely affect pension plans?
Yeah. First, let me say I agree very much with Professor Pollin that it ought to go beyond stocks. It should be a broad-based financial transaction tax, including derivatives. I think it can be done. I don't think it's going to have an adverse effect on pension funds. Again, it goes back to the amounts we're talking about are very small, and pension funds should not be engaged in day trading or in this kind of high frequency trading. They should be thinking about the long term. And if you hold a stock for the long term, which is the kind of thing that we would want our pension funds to put their money in, we're talking about 0.25% amortized over 10 or 20 years. This is really insignificant. If it could be shown, which I don't think it will be, that it were, you could have a carve out for the pension funds. But to me, it's inconceivable that this is a significant thing that should be a worry to anybody.
It's interesting to me because in my 401k plan, I buy about $20,000 a year in my plan, and my stock transfer tax on that would be about $50. I have to pay $250 alone just for the privilege of having an account, and that doesn't mention all the financial advisor fees, the brokerage fees, the asset management fees that are already reducing my rate of return. So what I often say is this is like a flea on the back of an elephant, and I think it seems like that's exactly your view, Professor Stiglitz.
That's actually right. And if we're concerned, I think we should be trying to encourage more competition in the financial sector to get those fees down. And there are a few companies that have actually succeeded. And that will require more transparency. The financial sector doesn't always like transparency. They like those fees to be hidden. So anybody concerned about pension funds should be advocating more transparency, not worried about this little flea that you described.
Yes, and I think one of the reasons why we had some problems in a prior administration with efforts to influence the comptroller of the state of New York was because it's so lucrative to get into the state pension system from from the standpoint of a financial firm, that people were going to great lengths, illegal lengths, to get into that process. So again, this is not, such a small tax. Now, a friend of mine who was a colleague of Professor Stiglitz at Amherst College a long time ago wanted me to ask him this question, and that is whether he feels that the tax would drive investors out of New York City.
No, this is exactly the same question we talked about before. There's not going to be any significant interstate movement as a result of the tax. And I think one way of thinking about it is to recast what Professor Pollin has emphasized. He talked about it's going to create more jobs than it loses, because there's going to be more spending on health and education. That increased spending on health and education makes the state more attractive. Those investments in roads and other public services makes the state a better place to live. So my view of this is good taxation is actually a way of increasing the attractiveness of a jurisdiction. That of course, is one of the themes of the tax justice network. You know, that if you have a fair tax system, that makes the society a more attractive place to be. And I think overall, this is moving our tax system into a better tax system. It's better to tax shares, transactions, or financial transactions than to tax workers working at a low income, or even certain kinds of productive savings.
So, Professor Pollin, you had indicated that you did a 2003 study, which I read, and then you had a study that's more recent. Have there been any changes in the market that would affect the effectiveness of a financial transactions tax like the one we're talking about?
Well, between 2003 and today, I mean, we had a great financial crisis. We introduced, between 2000 and 1998 was the deregulation of the Glass-Steagall, and then in 2010 we had the Dodd-Frank increase in the regulatory environment, which in my opinion not adequate in terms of regulating excessive speculation. So those are the regulatory environment has changed a lot. Within the market itself, the main thing that I would say has changed is that there has been, a very long-term trend of lowering transaction costs, just because the costs of effectuating a trade are just getting easier and easier. And so that we do have to be cognizant of that when we design the tax. And the paper that I published 2 years ago, I would say goes into excruciatingly detail on exactly where you should scale the tax, given that where transactions are, and that we don't want to shut down the market. I mean, the argument often is, well, sure, if you introduce this tax, you're going to end up with zero revenue because the market will shut down. People make these arguments. Well, that's true if you have like an 80% tax, but a 0.25% tax is not going to shut down the market. So we have to be cognizant of that. And one of the main things that in this 2018 paper that I did was to look at the evidence on transactions costs in different market segments, so that the bond market, stock market, and the various derivative markets do have different levels of transactions costs, and therefore, at least in our way of proposing it, we suggest that you have differential tax rates. So this was actually the bill that I wrote this paper basically after Senator Sanders asked me to give the research for the bill that I forget what he called his bill, but anyway, he introduced it in 2015, 2016. But the bill was designed specifically to reflect the differences in transactions costs. And so that therefore the tax rates are lower in the bond market and lower still in the derivative markets because the transactions costs are lower. Nevertheless, at 0.25% on stocks, as we've all been saying, is not going to change any level of activity. Just like the 0.5 in London hasn't changed anything.
So one of the things that has also been raised, we get it pretty much in our office, we get every argument that can be put out there against the tax. And, because this tax is technically collected and rebated, the Department of Tax and Finance of the state of New York publishes how much revenue would be raised by the tax, and the figures range from 16 billion in 2008 to 5.4 billion in 2009. I'd like to ask James Henry what he thinks is the reason for that rise and fall, what might be done to make sure that the tax raises more revenue along the lines that he indicated in his opening remarks, and what comments he has on the argument that it doesn't raise that much revenue.
Thanks for the question. I think, the main variation there is between 2008 and 2009 in terms of the state of the economy. I mean, 2009, March 2009 in particular, was the low point in the economic crisis that we had during that period. 2008 was actually a pretty good year. I remember the IMF's chief economist, July of 2008, predicting positive growth for 2009. But since then, we've had a revolution in the level of stock trading. And what was before, by 2006, you had fast trading, algorithmic trading accounting for about 30% of trades. Today, it's north of 85%. And that has just exploded. And consistent with that, you've seen, if you look at the heaviest volume trading days since the year 2000, 75% of them were in the year 2020. And so the total volume for the Dow Composite on average daily basis this year has been about 655 million shares. That's twice what we had last year. 600 billion shares. So we've had daily volumes escalating dramatically during this period. This year we've seen 85% increase in the Dow volumes. And I mentioned earlier the Apple statistics as well. So there's an awful lot of algorithmic trading that we don't really fully understand and can't observe. And by the way, the biggest players on Wall Street who own much of that trading infrastructure are folks who've been up to a bunch of other dubious financial activities. Credit Suisse and UBS are big investors in the automatic trading infrastructure. Renaissance Technologies, the Mercers out in Southampton and Stony Brook, they funded Cambridge Analytica. They also are big sort of market leaders in algorithmic trading. So, one side benefit of all this is we might, put a little, tickle in their.
Uh-oh.
Sorry.
What was that?
I think we lost.
No, did you lose me? I'm back.
Very briefly. Yeah,
Okay. Yeah. Okay. So I was just saying that, there's a lot of concern about the algorithmic trading and who's involved in it, financial secrecy, and whether it's appropriately regulated by the SEC. But the basic point is that we've had an explosion of trading. Part of it's due to this automatic trading, and it's also partly due to the economic collapse that we've had.
Right. So we've had some conversation about expanding this from a tax only on stocks to bonds and derivatives. In reading the literature, it seems that there are grounds for different rates for bonds and for derivatives. What are your thoughts on our ability to increase revenue by taxing those financial instruments?
Well, there's an extraordinary amount of volume in derivatives. there's a lot of technical difficulty in taxing derivatives, and the EU's proposal, latest proposal, is to put a 0.01% tax on the so-called nominal value of derivatives. I will refer you to the technical literature for this because
yeah, and I did read some of it, and
Yeah.
some people disagree with using the nominal value. There are other proposals.
That's right. I mean, the so-called option, if you buy an option, you're going to pay a price that's a fraction of the total stock involved. But basically, the point that economists make appropriately enough is that if you're a sophisticated investor, you can arrange transactions through derivatives and options and puts and calls and other kinds of instruments, swaps, that have the equivalent way of avoiding much of the tax if you leave them out of the tax picture. So there's a need to do something for them. One of the reasons the UK 600 and tax 0.5% basis points on stocks doesn't raise much money is because the financial community has figured out ways of arranging swaps that avoid that tax completely. So it's a de minimis tax, even though it sounds big. I think Professor Stiglitz is absolutely right. We need to include at some point derivatives in this equation. The question is really one of political feasibility and whether we want to get, I mean, as I understand it, and I have a question for you, which
Yes,
is,
sure.
Given the budget deficit that the New York State faces now, and given the lack of help from the federal government, the legislature has signed up, as I understand it, for a procedure that requires them to respond to whatever budget cuts the governor comes up with here in the next month or so within 10 days. And so it seems to me if we wanted to have a tax bill that provided for an STT, first of all, we need another name for this. It can't be that. But the stock transfer tax in New York, we have to get that bill ready to go. And it probably should be, there should be some, there's some value in simplicity here. And we can add the bells and whistles later on as we learn from experience. But in the immediate future, we need that revenue.
I think that based on the panel discussion, and also I had to do some more reading leading up to it, I think that Professor Pollin has a proposal to tax bonds that should be incorporated into it. And there was, I believe, in the Harkin DeFazio bill, a pretty effective way to deal with the taxing of derivatives that was different than the EU model. But there are a variety of proposals, and you just have to pick the one that you think is best. I wanted to go to Zephyr Teachout for a second here. Again, we still have this concern, which I am quite baffled by, which is this concern that people will go on the cloud. So just so everybody knows, and I think most people do, all the cloud is a series of computers that are located in different places. Any firm that's going to engage in trading on the cloud has to have an accounting system to record the pluses and minuses, as it were. So I find it very difficult to understand this concern about the cloud, things migrating to the cloud or out of state, as long as the participants, either buyers, sellers, or the firms effectuating the transaction, are in New York State. And I wonder, Professor Teachout, if you might comment on that. If you're not, I think she's muted. Hold on. Ask to unmute.
Unmute.
You're good.
Yeah, I just, we've been having a little bit of a conversation with some lawmakers in the chat, which is very useful. And I actually have to leave soon for daycare pickup, but I'm happy to continue this conversation with others who are working in the legislature to address these concerns. But broadly, this is why I was using the example of an amusement tax. There's a lot of transactions that sort of conceptually we think of as happening in the cloud. As long as the participants are facilitating the transaction in New York State. So obviously, if there's a transaction that is wholly outside of the state, where the entire sale happens in North Dakota, that isn't covered. So this isn't a extraterritorial law that reaches all transactions.
And we never covered stock transactions anywhere all over the United States. That was never what we did.
So the key thing is that you want to look at the facilitation of the transaction, and did it happen in state? And you can ask that without looking at where, you know, the hardware is that is also helping with the facilitation. You don't chase the hardware, you chase.
And that's the same with any tax on internet sales, correct?
Yes, that's right.
So, and I do think we have to look at the companies have accounting systems that could be monitored to make sure that they're properly remitting the tax, I would think. Just a final thought, and then we'll let you go for very understandable reasons. You've been involved in New York State politics, honestly. What do you think are the biggest political obstacles to achieving that?
I mean, I think there's an incredible amount of hunger right now because of the devastation we're facing. As Mr. Henry was saying earlier, that in a tragic way, the scope of the need, I think, creates a real opportunity here, because the austerity budgets are really leading to devastation around the state when you look at the budgets we're looking at right now. So the key here is of course, political action, and people recognizing that this is something to push on. It's plausible. It's really important for the reasons that others have given. New York State is in a changing moment. We have a Democratic Senate and a Democratic legislature for the past 2 years, and that led to some extraordinarily powerful positive changes in real estate laws, taking on some of the most entrenched interests in New York State politics in the last 2 years. If that can be done in this case, the entrenched interests, as a few of you were saying, I think it was Mr. Henry, there are not that many of them. So it's a matter of political will, but the Democratic leadership in both chambers is quite powerful.
Yes, I think very powerful if they decide to choose to use that power. I would certainly agree. Anyway, I know that Professor Teachout has to leave, so thank you very much for coming. What I think I'm going to try to do now, if we can do it correctly, we had a little difficulty starting this program, but there is a procedure in Zoom where the attendees can raise their hand and I can unmute them, and then they can ask questions. So if our participants our participants would like to ask questions, you can raise your hand and we'll do our best to make that happen. I see my colleague.
I can't raise my hand because I don't have the video, so you couldn't see.
No, it's on the. Oh, I see what you're saying. It's Gene Grabiner from Buffalo.
How do I get the video?
There should be on the bottom of your screen where it says there's the second button from the left.
It says share screen.
No, more further to the left, there should be a button regarding video, and then you can do this. But actually, in the when you look at the
there we go.
All right.
So
did you have a question, Gene?
Yes, I do.
Okay.
And I sent you an article about this also. Governor Cuomo is tied up with Wall Street. So as a practical question, is it possible for the legislature to generate a sufficient majority to override a veto of such a bill? Now, the tax already exists. It still exists. We have to get rid of the rebate form. But then, as Professor Stiglitz mentioned, and Professor Pollin, we have to expand the tax beyond stocks. But the practical question is, could a veto be override? That's one. The other question is, how can mass support for this tax be built in sufficient time? We're already in a quasi-austerity mode, and by having austerity as a response to austerity is terrible. Now, we've been sending editorials to the Albany Sun-Times. They published one. There was one in City Limits. The New York Times refused to publish it. But anyway, those are the questions.
Well, I'm not sure that I can answer that here or that the panelists can. I see a hand raised from my colleague, Monica Wallace, Assemblywoman from Buffalo. I could really put her on the spot and ask her, you know, her thoughts on the political process. And if she wanted to share them, that would be great. But for now, let's come back to that. I will unmute Monica and give her the opportunity to ask a question.
So thank you. First of all, I just want to thank you so much, Phil, for putting this on and for all the experts who have spoken so far. It's incredibly informative. I've learned a lot. My question was actually for Professor Teachout. She had to leave, but I figured I would just say it anyway so everybody kind of understands what I'm getting at. Maybe, Phil, you know how to answer this. I am familiar with the Wayfair decision that she's referenced, and I'm just trying to get a better understanding of how. So under Wayfair, it's the, you know, the nexus that you're creating with the state that allows you to tax. You don't need the physical presence. So I guess what I'm trying to understand is, let's say hypothetically some of the stock traders move to New Jersey, like they're threatening to do. That doesn't mean, if I understand it correctly, as long as the purchaser of the stock or some of the sellers of the stock are physically located in New York State, residents in New York State, you still have that nexus. Am I correct on that?
That would be correct. But also, I think more importantly, if the transaction was facilitated through an exchange, then you would have that nexus as well. You have to have some nexus. I think we all go back to law school and remember minimum contacts in a different setting. But Professor Pollin had actually studied the likelihood of firms moving. And one of the things he noted is that the firms pay much, much higher costs just to be in New York City. They pay higher real estate costs. But the other thing that I've always said, and I'll let Professor Pollin comment on this, is that they would incur extraordinary expenses to move to avoid a tax they don't pay. Remember, the firms do not pay this tax. It's the buyers and sellers who actually pay it.
Oh, okay.
Right? Mm-hmm. So one of the things the governor actually says very truthfully about taxation in New York is that we export 20% of our tax revenue to other states, either because of federal income tax being maldistributed or because of excise taxes that we pay to places like Texas or South Dakota to bring oil here to New York. And one of the great things about the stock transfer tax is most of the people who would pay it are not from New York. A lot of them aren't even from the United States. But I would ask Professor Pollin to comment on what his research showed on the likelihood of anyone moving their offices to avoid a tax that they don't pay. Oh, he got muted again. I have to ask him to unmute. I think he can unmute himself, and I think he did.
Right. Again, I think people will avoid the tax when the tax is high. Yeah, if you're going to impose a 20%, 30% tax, then people are going to avoid the tax. But if we're talking about, you know, 0.25% tax, there's not enough incentive to move. There's other things that people want to spend their time on, and the tax will not be one of them. I would also add this one other point. In fact, I think it's establishing the legal basis for people paying and to minimize avoidance is actually not that hard. And the reason is that basically what you can establish, I'm not a lawyer, but I know there's a lot of lawyers on here, so I'm going to go out on a limb. But basically, if you say that, you know, I want to own shares of Apple and I'm trying to buy it, well, you know, the trade does not have legal title until you pay the tax. So, okay, I'm going to pay on, you know, on my $1,000 trade, I'm going to pay $2.50 because otherwise I don't legally own the stock.
And you know, that's
So,
an outstanding point, and I want to bring back Monica. Maybe is significantly younger than me. But when I first started in the practice of law, we would go into corporate files, and in those files, you would see stock certificates for a privately held company that had the tax stamp on it. And the reason for the tax stamp was exactly what Professor Pollin has just said, was that to make the transaction legal under New York law, you had to pay the tax.
yeah, in fact, the tax in Britain is actually called a stamp tax. So physically, at least in the old days, they put a stamp on it. But the point is, why would anybody try to avoid a 0.25 tax if their trade doesn't have any legal status? So I mean, I think this applies across the board, whether it's a state level, whether it's a national level, or if you even want to get, you know, international coverage for this tax. The problem with avoidance, I don't think is that. It's what James Henry mentioned, and it's come up, is the fact that if we're just taxing the stock market and not the bond market and not the derivative market, then you do get migration out of the stock market into the derivative market, because you can construct options that effectively achieve the same thing as a stock transaction. So, and that in the UK, that is, in my opinion, the big reason why they don't raise nearly as much revenue as they might otherwise, because they only are taxing the stock market.
Go ahead.
In
sorry.
other, like Hong Kong, they have it across the board, and it's more effective that way.
George Albro, you have a question?
Yes. First, thank you, Phil, so much for organizing this event. This is really informative, and I'm very impressed to see all the legislators who are on this, including my own Assemblywoman, Joanne Simon, and the soon-to-be Senator Patrick Nelson, we hope.
A former staffer of mine. I always have to throw that in.
And I'm also announcing that unless Amazon rebates my sales tax, I will be leaving the state of New York and going to the cloud. Exempt from that. But I think the 2 points to really consider is, one was raised that this is, the tax is already on the books, and in all the transactions, it is actually assessed and then rebated, so that politically there is an advantage where you have a tax that already exists, and as you pointed out, Phil, has existed, you know, without the sky falling down for years and years and years. And I understand, I might be wrong, but with the legislative fix would just be eliminating, either in whole or part, the rebate procedure. So it's not a new tax that would have to be imposed. And that, I think, has certain political advantages. So the second point is, someone had raised about the pensions. The governor seems very adept at defeating progressive legislation by employing and recruiting unions to come out against that legislation because of his political content. And he did that with the New York Health Act. He's doing it with divestment efforts, and he may do it again with this tax on the pensions. So if something has to be enacted fast to avoid massive layoffs, maybe a cutout of pensions might be, a carve out of pensions might be a way of avoiding that political inhibition.
Well, one of the things that our bill did do originally, because it was drafted in good economic times, it provided that all the funds went to infrastructure. And the reason we did that was to try to get organized labor on our side. And I believe we are succeeding in doing that. The other obstacle, the main obstacle in talking to unions that you see with this is they have people on Wall Street who advise them because they have pension plans with lots of money.
Mm-hmm.
And when they start to realize that the asset management fees, financial advisor fees, brokerage fees are all cutting into their rate of return, I think once they start to look at that perspective, then they're much more receptive to this. But it looks like I'd like to give the remaining three panelists some opportunity to sum up their thoughts on this, and we can continue to take questions, but we may not have any more. So Professor Stiglitz, it looks like you are unmuted. Any further thoughts you'd like to share?
No, I think you've covered most of the important topics. I think the fact that the money is so desperately needed, one way of framing the issue is you are spending money now to give, the rebate is an expenditure.
Mm-hmm.
You're taking tax revenue and you're giving it to the financial sector. In a time of need, is that the highest priority? Do we want to give it to the financial sector, or do we want to give it for other uses? So given this peculiar legal situation you're in, that might be one way of framing it. I don't think it is that difficult to extend it more broadly. And I think it would be a good idea to do that. And conceptually, the basic frame, you don't have to get it perfect because the amounts are so small, but conceptually, you want to make sure that no one avoids the tax by buying a derivatives that does the equivalent of buying a share. So the rates ought to be set such that the tax on the derivative of a stock is equivalent to the tax on the stock itself. So that gives you a conceptual framework that it is a way of getting at the underlying stock transaction. And I think that could, as has been pointed out, other places have done this. So, just in conclusion, we're in a desperate financial situation. It really is true. And remember that the stakes never fully recovered from the 2008-9 crisis. Employment in the states and localities in 2019, before the pandemic, was lower than it was before the 2008-9 crisis. So if we don't find additional sources of revenue, we're looking at a devastation of the public sector at the state and local level. And that will have very serious consequences for our productivity and for our society.
I'd like to return to reiterate something you started with, is that we want a tax activity that is not helpful. We want to tax things that are harmful. And could you summarize again why you feel that this type of tax accomplishes that?
Well, it goes back to, in many ways, back to Keynes's original conception of what this is. A lot of this is a rich person's gambling casino. Now we have more participants, but on the other hand, if you include the high frequency trading, which is such a large fraction of trading now, it is even more of a speculative, an exploitation activity. And I've argued elsewhere that actually a lot of people talk about what they call the liquidity and the discovery functions associated with stock transactions. One of the things that I've shown is that actually all this high frequency trading, all this high trading actually undermines both the price discovery and the liquidity function. Liquidity is there except when you need it. So the point I would make is that this actually encourages more long-term behavior. Not a lot. It doesn't have a big effect in behavior, but it has a little bit. And everything we can do to encourage more long-term thinking is going to lead to more productive economic activity. We want people to be thinking about the next nanosecond, but about the next 10 years. And when we talk about building back better, part of building back better is thinking long-term. And so it's even symbolically, it's reminding us we ought to be thinking long-term. And if you are making long-term investments, 0.25% over 10 years is 0.025% per year. And that's really, really small.
Well, thank you very much. I'd like to go on now to Robert Pollin for some concluding remarks.
Okay, thanks again. And this has been extremely interesting, and I appreciate your efforts. I would just, again, we've already said it, but it's worth repeating that there's, I think, a lot of benefits to be gained by expanding the tax to include the bond market and the derivative market. And yeah, so I hadn't remembered the name. So it was the Inclusive Prosperity Act that was introduced by then Congressman Keith Ellison in 2012, and then Bernie Sanders introduced it in the Senate in 2015, and that they asked me to do the research on it because I had done previous research building off of the stuff that Professor Stiglitz had done in the late 80s and others. But I would just add that on a couple points, in terms of the magnitude of the crisis faced by state and local governments, for some other work I'm doing right now, I was reading some excellent work. I think the best model I've seen by Timothy Bartik, who I think is a very excellent economist at the Upjohn Institute, who is estimating that over the next 12 months, if nothing is done, we're looking at, not just for New York, but state and local governments in general, $1 trillion revenue shortfall, which is roughly 20 to 25%. And so that means if we don't get revenue from someplace, we're going to see 20 to 25% layoffs, because in education and healthcare, which are most of what state and local governments pay for, that's the reality. In terms of the politics of it, and again, I'm a total amateur because you're some serious political people on this. I'll just mention how I got recruited into this most recent work that I'd done some work years ago. And I just got a phone call out of the blue during the financial crisis from somebody named Roseanne DeMoro, who is the president of the National Nurses United, asking me if I would get working on the financial transaction tax again. And I said, well, interesting, but what does that have to do with nurses? And she said, because we are a social movement and we're not just looking out for the contracts of our membership. So that's really how I started doing the work that ended up with Bernie Sanders. Now, at the time, I didn't think that much would come of it, but they had enormous success. They made a name. They called it the Robin Hood tax. It's the same thing, but it's called the Robin Hood tax. And they recruited basically people from all ranges of society and labor movement and elsewhere in behalf of it, to the point that they had a press conference with the Pope at the Vatican supporting this as a moral imperative. Now, again, I'm an amateur and I'm not going to tell you how to organize support, but I would certainly look at the lessons that they pursued, the nurses union, and making this a very mainstream, easy to understand, ethical kind of issue.
Excuse me one second. You'd have to blow that up. I can't read it. It's too long. People probably saw me fiddling with my phone, but if you didn't, I was trying to find a tweet from Robert Reich, and it says here today, your reminder that the richest 1% own half of the stock market, and the richest 10% own almost all 92% of it. So when Trump brags about the stock market, he's not talking about the economy that 90% of Americans inhabit. So, James Henry, your final thoughts on this issue? We might have one other question, but it was so long I couldn't make head nor tail of it without a little help from my staff.
Well, thanks for being on this panel and leading this panel. It's terrific to see everyone together. I do think that the point about this being primarily now a political race, political issue is fundamental. And you know, in the Hamptons right now, we have an outpouring of New Yorkers who happen to have, you know, the happy few who can afford to leave. And real estate market is up 25%. The Hamptons has a kind of financial transactions tax. It was supported by a Republican named Fred Thiel, who is still a member of the legislature. And it's a 2% tax on every property sale over $1 million. So it raises a phenomenal amount of money, and all of it's dedicated to conservation. That tax, I think, is kind of an interesting example of how it's, you know, it's not financial transactions, but it is a real property transaction. But it can, this kind of transaction-based approach can even be popular with conservatives in some contexts. Governor Cuomo has an opportunity to lead on this issue. New York is ahead of the rest of the country in terms of the financial crisis because we had such a deep downturn. I think we're going to be ahead with the fiscal cutting as well. And so, you know, if he recognizes this fact, he doesn't have to just rely on Wall Street. He can realize that this is a solution for his dilemma here in terms of, otherwise he's facing radical layoffs. And, you know, I think the other key point is here, I have a letter in front of me from Henry Morgenthau, Jr., who was Secretary of the Treasury in 1937 during a similar financial crisis, written to FDR. And these are two New Yorkers. New York, you know, FDR had been governor, and Morgenthau and he were neighbors. And Morgenthau is writing this letter, noticing that in response to the increase in income taxes, 1932 and 34, there were a number of people who had shifted their activities offshore. And the havens that he was complaining about, one of them was Newfoundland, another is Panama, Bermuda was on the list. But he closed off the letter by saying this, that the great bulk of our tax returns are honestly made. Legalized avoidance or evasion by the so-called leaders of the business community is not only demoralizing to revenues, it is demoralizing to those who practice it as well. It throws an additional burden of taxation upon the other members of the community who are less able to bear it and who are already cheerfully bearing their fair share. The success of our revenue system depends equally upon fair administration by the Treasury. And the people who have it should pay. And I think that moral point needs to be made among all the arguments about high risk, you know, trading and, you know, who this tax would affect and whether it's going to cause people to shift. People who live in New York and love this state have a duty right now to give up a little bit if they're in the Wall Street community, to support the rest of us who don't. And I think that's a moral obligation, an argument that economists don't always make very well, but it is, I think, at the ground level of what we're talking about here.
Well, I know one thing about politics, and that is when you come to your speech, you know when the punchline is at the end. And there's not a much better punchline than a letter from Henry Morgenthau to Franklin Roosevelt. So I think this has been a great discussion. There is one person whose question didn't get answered, but we will get, because again, we've got to the punchline, but I'm sure that we will get back to that person individually. And it's been quite an experience for me to put together this terrific panel with the experts here. And again, just thank you for coming, and for those who listened in. I've certainly learned an awful lot about this whole question, and I'm sure it will make for better legislation and hopefully better politics. Thank you all so much.
Thank you for pulling this together, Phil.
All righty.
Great work, everybody. Thank you.
Take care.
Onwards.
Any chance there's a summary we could get? Who took the best notes?